Okay, good afternoon, everybody. Still got some people joining us on the call, but we'll make a start. Thank you very much for joining us on this lovely summer's afternoon. I'm Alan Cowie from the New Anglia Growth Hub. We provide free support for growing businesses in Norfolk and Suffolk, and we can come see you. We can sit down and discuss your growth plans with an advisor who, by the way, is completely independent and impartial, and we'll try and find you some free or subsidised support. Today we're going to be talking about bank lending, and Barclays have been supporting our series of webinars, and today's guest is from Barclays, and I'll introduce her in just a moment. Before I do that, just want to tell you what we've got coming up, because next month our innovation advisor Morgan Potter will be speaking about R&D tax credits, a government incentive designed to encourage innovation. It's been going for over 15 years, but not as widely publicised as it could be. So he'll be going through what sort of business activities can be considered, and he'll be debunking some of the myths. And no, don't worry, you will not be investigated by HMRC for attending that webinar, and I'll send out the links for that after this as well. Then in August we have Gary Townley from the Intellectual Property Office giving a very lively and visual presentation. I've seen his presentations before. They are very well worth attending, and he'll be talking through the 4 areas of IP: patent, trademark, design and copyright. Every business owns IP, so what do you own? So join us if you can for any of those. Before we crack on, just want to quickly tell you, if you've got questions, you can either save them till the end. There's a little icon which looks like a little hand, so you press that, I'll unmute you, you can ask your questions. Alternatively, you can just pop them into the chat box as well. So today it's all about lending. We work with a whole host of lenders, from high street to alternative, crowd, cloud, venture capital, much more. And our guest Sadie Moore is a business manager at Barclays, responsible for managing a portfolio of mixed industry businesses with an annual turnover of between £1 and £5 million. Now, Sadie, you must see an awful lot of applications, and so I guess it's really important for us to understand exactly what you're looking for, so then it'll make those applications stronger and more likely to be approved. Good afternoon, Sadie.
Hello, Alan. Thank you. Yes, absolutely. And what I really want to do today is just spend a little bit of time going through what exactly that we look at when we look at or assessing lending applications. As you mentioned, I've been, I'm the business manager for Barclays, and I have been doing it this role for 10 years. Over the years, I've seen lots of different funding requests, and they can vary from overdrafts, sales financing, asset financing, to commercial mortgages. So what we tend to look at is, most importantly, is each sector we look at differently. So it could be that they're in a low risk industry, where we may look at that slightly differently to someone that's maybe trading from a newsagent or a heavy cash business. The term is really important as well. And we, like I said, the most important thing that we tend to do is look at each case individually. What I'm going to do now is go through like the main criteria for what we look at when we're presented with a lending application. So first of all, the character. Who are we lending to? Are they trustworthy? You know, what is their background? Have they banked with us? Do they have any experience with the trade that they're in? Have they had any experience with any other trade? So it really is important to understand the customer, where they've come from, and what they're about. Once we're comfortable with the person that we're looking to lend the money to, we'll then look at their ability. So again, you know, ability, is there a good business plan in place? What research have they done? Have they got any qualifications in the trade that they're in? What have they done with their marketing? Most importantly, we'll look at their ability to sustain the loan. Once we're happy with the ability, we'll then look at the bank margin. So we assess the risk against the reward, which is quite simply, you know, are we going to be making, I suppose, a profit from it? In the end of the day, we are a business and we have got shareholders to pay, so we do have to consider this. So then we would then look, moving on to the purpose. So once we're happy with the person that we're lending to, so the character and their ability to pay us back, we look at the purpose. So why do they want the money? Is the purpose legitimate? Is it in line with the business that they're in? Can the purpose of the loan or the overdraft or the type of funding that they're asking for be verified? Is the purpose compatible with their type of industry that they're in? We will also all the time consider and refer back to our lending policies and criteria. Again, it all boils down to whether the purpose is right for the business. So once we've got the character, the ability, and obviously taking into consideration the bank's margin and the purpose of the loan, we look at the amount. This is really important. Is the amount correct for what they're looking to do? What we often see is people sometimes can request too much, which obviously further down the line can cause problems, or too little. So they've asked for £70,000, say, to do a refurb on a building. 6 months down the line, it's not quite enough. So what do they do then? So we'll always ask that question: is the amount that you're asking for enough, or is it, like I said, too much? It's really important. With regards to the amount, we'll look at how much the customer has also put in to the certain deal. So it might be that if it's a new business, they may need to put in a stake. So where is this stake coming from? Is it their personal funds? Where is it, has the customer had to borrow the money to put in? If so, would we be comfortable with that? So again, really need to assess the amount and make sure it's correct for the client. So just going back, we've got the character. We're happy with the person we're lending to. They can afford to repay the loan. Their ability's there. The margins, we're happy with the margin. The purpose is correct. The amount, they've got the amount right. So now it's a repayment. Is there sufficient sort of cash in the business to make the repayments of the loan? Cash is king. If the business is making high profits but there's no cash, then obviously that's not gonna work. So it's really important. And one thing that we can do with repayments to make sure that they are comfortably met is to fix the interest rate. So we may look to fix it on a say a 3-year term. The client then can budget what their repayments would be. We also look at if there's any secondary sources of repayment. So if that business is reliant on, say, they've got a 50% income stream, and that income was to go, how would they be able to afford it if that was to fail? So what is the succession plan in place? And then last of all, we've got insurance. So has the business got relevant insurance in place? This could be key man cover. So what if that one person was taken away from the business through ill health? What would happen to the business then? So we want to see that there's some sort of plans in place. This could be interest rate protection. So going back to fixing the rate, so the business will know where they are in the next 3 to 5 years. It could also we could also look at the security for, say, for commercial mortgage. What security have we got in place, and is that well protected? Because what we don't want to do is for someone to put their house up or their business up and then something to go wrong down the line and not having the relevant insurance in place. So just going over what I've just sort of said, Alan, is we look at these 7 basic key factors which are really important. So it is all about our gut feeling at the end of the day. Are we lending to the right person? Have they got a plan in place? Can they afford the loan? And is the purpose right? And obviously the amount. So the next thing that we look at is the financial statements. The profit and loss trends, are they going in the right direction? Is it in line with what their forecasts maybe were? Is the balance sheet consistent? Really important. Is the balance sheet consistent? And then also dividends, are they discretionary? Look at what comes out of the business. Is it needed? And also year on year, if someone's got a really lavish lifestyle, obviously those dividends may be that they're needed. Are they too high? Are they consistent? So we really drill down and look at what's coming out of the business and what cash can be kept within it. I think I mentioned before that cash is king. And if you haven't got enough cash within the business will just fall over. And again, going back to something else I mentioned, if 50% of your sales are from one supplier, what happens if that one supplier was to go somewhere else? What plan would you have in place? So they're the types of things that we would look at. And then we've got statement of means, which we call statement of assets liabilities. So we look at the strength behind the person, that sits maybe behind the business. So what are their personal assets? Have they got a lot of personal debt? What are their personal assets? So property, cash, savings, that sort of thing. So we really want to find out about that person behind the business. Are they, going back to character? Are they trustworthy? Have they had previous problems in the past? All of this is assessed at the time of an application. The last thing that we've got here is the difference between a cash flow forecast and a profit and loss. People sometimes get these confused, but as I've mentioned, cash is the lifeblood of any business. If you haven't got the cash in the bank account to make the loan repayments, then unfortunately for lending applications, they're going to go nowhere. So cash is king. So kind of that brings me to the end of what we'd look for. Do I have any questions?
Yeah, thank you, Sadie. I've actually just got a quick question here myself, which is, what stage should a business be at before they come to speak to you? And do they need to be an existing business, or could they come to you with a plan, they need to raise some finance, and they're speaking to you from the earliest stage, or do they need to have already been trading?
No, absolutely. They can come to us at any stage. Obviously, we need to have a little bit of an idea about what they're looking to do. So they want to have spend a little bit of time researching and putting some sort of plan together. Mm-hmm. But our business managers that deal with the startup market can certainly help with that. Mm-hmm. So they can come to us at the right from the start. We can help them or point them in the right direction to put the business plans in place. Mm-hmm. So no, Alan, the answer is they can come to us at any time.
Any time, right? Okay. Question here from James. Can you hear us? Okay.
I can, yeah.
Yeah. Speak up a little bit if you can.
Hi, James.
Sorry, I'll come. Hello, hi, Sadie. How are you?
I'm very well. Yourself?
Yeah, good. I've got a question about what exactly you could borrow money for. I'm aware, obviously, banks are keen to lend for things like premises and machinery and things like that. But what about other sort of costs like marketing or wage costs or those sorts of things? Could I borrow money for those?
Yeah, I mean, for more of like a working capital cost, we'd look at an overdraft facility, whereas it may fluctuate during the month. So if you've got, like, say, wages, so your cash is taken up at a certain period in the month before you've got your cash coming in, then we'd look at the overdraft option, and depending on how much the business required, we'd be able to do that either unsecured or secured. We'd also, James, be able to look at cash flow finance.
Right. Okay. And just one other... Sorry, I interrupted you, carry on.
That's okay, no, that's fine.
Sorry. So in theory, those sorts of costs could be looked at. It'd just be a different type of borrowing, would it, rather than a loan?
Yes, we have many types of different borrowing that would, I guess, sit with every situation. Not every client, not every customer is going to be the same and have the same needs. And I think where we, truly believe where we come from is that we assess every situation differently. So someone may walk in off the street and need an overdraft because their cash flow is a little bit tight at certain times of the month. Other people may have some, big invoices that they need to fund against, which we look at sales financing. Again, someone else might want to buy a bit of machine that we would look at doing some asset finance on. We could use the machinery as security. So there really is such a massive scale of lending that we do for all different needs.
Thank you, James. Thank you, Sadie. Remember, if you have a question, just hit that little button, the hand button, and I'll come to you straight away. Just a quick question from Alicia here. How can you find out about poor credit rating? I mean, I think there are a number of websites out there. Are there any other ways of actually just checking to see what your credit score is?
Well, for you personally, then Experian. That'll give you a good indication, because we do a credit application when we put any lending applications through, which will assess that information, and which all comes from the second, for the first one I mentioned, which is the character. So really important. You know, if you're going to put forward a lending application, you think, oh, I may have something there in the background that they possibly may, you know, flag up. Then tell us, because if we know about it, we can possibly, you know, obviously get round it, you know, if there's a solution there. So really important that we know about these things. And then if the business, you know, if they've had any, sort of limited companies had any, you know, debts, so to speak, then that will all be registered with Companies House. So again, the credit application will flag any of that up.
And does the bank look for personal guarantees as well?
Yes,
and you mentioned security.
Yeah. Yeah, so the most favoured thing for security is a tangible security, so a charge over, you know, a property, land, but we will also look at personal guarantees as well. You know, we can lend up to certain amounts with just the personal guarantee in place, if the other security, the land, isn't there.
Okay. Got a question here from Frank, who says, what forms of security do you look for? I think we've just gone into this. When you're dealing with an early stage business or pre-break even, assuming no hard assets. But again, I think you just about covered that, didn't you, when you talked about those personal guarantees, if there are no, you know, hard assets to secure against?
Yeah, yes, we do. Look at all different types of security. Whether there's if there's not the land charge there, one thing that we do is an EFG loan, which is an enterprise finance guarantee, which is a scheme that's backed by the government. Well, they're secure. Is it 75% of the loan? So that's what we can look at. If there's no actual physical security that you can offer us, we can go down that route.
Okay, thank you. All right, so last chance for any questions. Stick your hand up. Oh, got one more coming in here from Julie. Do the interest rates change based on the results of the bank's risk assessment of the business?
Yes, yeah, they can do. They can do.
Right, okay. Any other questions at all? Okay, so we will leave it there. I'll send out the information about this, some slides, and share the contact details for us as well if you want to have a chat afterwards. But thank you very much for joining us. Hope to see you on the next webinar. Good afternoon. Thank you. Bye-bye.